hopefully Stephen will join us in a second, but I know you guys also have quite a bit of experience as well. So I think we'll have a lot of great expertise to share with everybody already. All right, just for you to know, Kat, I'm going to start in a few minutes, or not a few minutes, in about 5 seconds. So go ahead and start streaming if you'd like. Wonderful. Well, good morning, good afternoon, and good evening, and welcome to the Nest on Clubhouse. My name is Jim Chu in San Francisco, California, and I'm the CEO of Untapped Global. Our goal is to connect international investors with entrepreneurs in frontier markets, including those in Africa and Asia. We host weekly discussions on Clubhouse about entrepreneurship and investing, and once a month, we host pitch sessions with startups and investors from around the world. You can find out more and follow us at Untapped Global on Twitter and LinkedIn, and you can join our WhatsApp community by going to untapped-global.com and clicking engage. Today's topic is valuations of African startups. Talking about company valuations is never a straightforward affair, and especially for early stage companies, how you get to a valuation is often a black box. For African companies in particular, many say that inaccurate risk perceptions skew valuations downward, while others see huge jumps in valuations just for being incorporated in the US or the UK with no difference in their business. We have 2 panelists today and a number of other experts on this topic. And in the second half of the hour, we open the conversation to the audience to get your experience and insights. I should note that this conversation is being live streamed and recorded. So if you have friends who appreciate the discussion or are not on Clubhouse, they can find us on LinkedIn under Untapped Global and listen in to comment. We'll do our best to read relevant comments and questions we see in the chat. And if they miss it, or if you miss this or parts of this, you can find this chat and past discussions on our podcast at anchor.fm/untappedglobal. All right, let's get started. First, to our panelists and guests. We have Adenike Sharif and Stephen Deng, who I see has joined us. And we also have George Payne, Laurent Lamott, and Raj Kulasingham. All right, let's start with you, Adenike, with an intro. Adenike, are you still there? I think you're on mute.
Sorry about that.
No
hello,
worries.
everyone. It's such a pleasure to be here this afternoon. It's afternoon here in Lagos. My name is Adenike Sharif, and I work as principal at Future Africa. Future Africa is a fund that invests in early stage companies across the continent. We also partner with them to provide coaching and community. In addition to that, we have a community of co-investors from all over the world, over 200 co-investors now, who join us to co-invest in deals. Once again, it's really a pleasure to be here.
Great to have you back. You were in our previous conversation about blockchain and cryptocurrencies in Africa. So that was a very interesting conversation. We have Stephen. Welcome, Stephen. Thanks for joining us. Would you like to introduce yourself?
Yeah, hi, Jim. Thanks for having me. It's always great to be on a Nest production. So my name is Stephen Deng, one of the partners at DFS Lab, and we're an earlier stage investor in digital commerce companies in Africa. So we're very specifically interested in companies that are building for the whole commerce stack, which includes things like fintech, logistics, discovery, SME, services, and things like that. So I think this is a very pertinent topic right now, so really excited to be a part of the conversation.
Great, glad you can make it. And we also have Laurent Lamott as well. Laurent, would you like to introduce yourself?
Yes, I'm Laurent Lamott. Jim, thank you for having me. I'm the former Prime Minister of Haiti and also the chairman of our ventures that we recently launched to invest in startups in Africa. And I'm also the founder of the Overvalued Group, which is a company that's been doing business in Africa since '98 and over 42 countries in Africa, basically in the reg tech sector, so providing technology to regulators around Africa to better equip them to face the digital revolution that we're noticing right now in Africa. So it's a pleasure to be here, guys.
Great, thank you for joining us. And Raj Kulasingham, you're a regular on the show. Great to have you as always.
Yeah, I always feel I'm missing out. You know, there's that FOMO thing. I feel if I don't come here, I'm not learning. I'm not learning. So now I'm here to learn, right? So okay,
Great.
my name is Raj. I wear two hats. One hat, I'm a lawyer at a international law firm called Dentons, and with the other hat, I'm a active angel investor, investing across Africa, but also in the UK, and with some digressions into ASEAN and a couple of digressions in Silicon Valley, investing with really great co-investors like Laurent and you, Jim, and like super excited to see, you know, this ecosystem growing over the last 3 to 5 years in a way that I did not think was imaginable.
Yeah, great. So I'm sure you've seen a lot of different companies and a lot of different kinds of valuation. So on to the topic, are African companies undervalued or overvalued? What do you think? Who would like to start?
Well, maybe I can give you one anecdotal piece that, you know, I'm looking at a company recently where, well, okay, let me sort of wind back a little bit, right? So I think historically valuations of African countries have been comparatively low compared to whether it's US, UK, or even Asian companies. I think certainly in the last 2 years, and certainly in the last 6 months, especially for Nigerian fintech companies, valuations I think are creeping up. There's a lot of excitement caused by, you know, Paystack, Flutterwave, Kuda, and I have the fortunate position of being part of that excitement because as an investor in Kuda, Flutterwave, and Paystack. So there's a lot more spotlight has and valuations are going up, and to the point where, you know, really hot companies, you're seeing valuations change literally by the week. There's one company I looked at, no names, 3 weeks ago, valuation wasn't one number, and 3 weeks later, it was almost double the valuation, both on safe notes. Now, is that a bubble? Is that just the valuations being, you know, reaching the same levels as you would see in Silicon Valley? That's a question that I would put to the others. I'll be interested to hear their views.
Great. Adenike, Stephen?
Okay.
Well,
So I think that I would start from, you know, what is valuation in itself? And typically and traditionally, it's a quantitative way of analyzing the fair value of an asset so that you know how much of it that you're going to own. But in parallel, in early stage investing, the truth is that there isn't much information that exists to arrive at that quantitatively, except you want to be dishonest with yourself, because typically the company hasn't been in existence for long enough that you can, you know, use their financial models or management accounts or do a multiple on revenue, you know, in a way that makes sense. And so typically what happens is that founders and investors agree on what a fair valuation is based on what's happening in the market, where the company is at, the background and pedigree of the founder, their technical expertise, the problem that they're solving and the size, the potential size of the problem, and then what's happening in that space as well. So if you're investing in a fintech company, for instance, you're typically going to see a higher valuation nowadays. Why? Because Paystack and Flutterwave have shown, you know, the type of exits that are possible. And to me, and you know, my investment philosophy is essentially that evaluation is a bet on what the future growth of that company could look like. So at the very earliest stages, it's not so bad if you're buying shares at a valuation of, say, for example, 10 million, if that could go up to 1 billion. You know what I mean? At the end of the day,
right.
It wouldn't really matter whether you bought it at 10 or you bought it at 15 or you bought it at 25 when it goes up to 1 billion. But at the same time, I think that there needs to be some element of reality. based on the markets that you're dealing with and the constraints that are involved in that market. Because even though there's the opportunity to grow very large, there's still a lot of constraints. And I always tell founders, the worst position to be in is to overvalue yourself at the very earliest stages. Granted, investors might bite and pay for that, but if you don't meet certain targets by your next round, you're going to find yourself in a very difficult position where you are unable to raise at a healthier valuation without diluting yourself too much, because essentially you've not done what you said you would do. So I think the question is, are companies overvalued or undervalued? Because valuation is very subjective at the very earliest stages. It's what valuation makes sense for the companies in their spaces. The second part of this conversation is that do we say American companies are overvalued? And Clubhouse is raising at a 4 billion valuation. This is a company that has only existed for 1 year. That valuation is simply a reflection of investor demand, because they're operating in a new space where people feel like there's optimal room for growth, and it's reminiscent of Facebook's earliest rounds. Nobody wants to miss out on what could be the next Facebook, but it will help to also remember that Facebook actually had a down round at a point in time. So it's very subjective. Try not to shoot yourself in the foot. I would say the annoying thing is that these days, it almost seems like after you have a call with a founder and they tell you a certain valuation, every 2 days, based on investor demand, after that valuation changes. And I don't know, that's absolutely crazy. Most of the principled investors that I know will not be pressurized into investing in any deal, no matter how hot the company is or the market is or whatever. So to me, it's always
so what I hear is potential markets, potential exits. A lot of it is subjective, and at the end of the day, don't get pressured. All right, thanks for that feedback, Stephen. I'd love to hear from you.
Yeah, I'm glad I'm going after Adenike, because she's so good at laying out the lay of the land. I agree mostly with what Adenike and Raj are saying, which is, a lot of valuation is more art. Like, there's the saying that we're very good at overestimating what can be accomplished in the short and midterm, but underestimating what can be accomplished in the long term. And I think the scale of valuation changes depending on how optimistic people are about the long term. And there's a lot of recency bias, right? Flutterwave, Paystack, especially the Nigerian companies now are seeing valuation jumps due to the kind of recency bias that's happening. And I personally think that a lot of assets right now are overvalued, not necessarily just in venture, but just broadly globally. I mean, we look at what's happening on just even the retail kind of public markets, and we see what's going on in terms of meme stocks and what's going on in certain alt crypto communities, NFTs. There's definitely a sense.
Are you calling for a crash, Stephen?
I will never call for anything.
A correction, not a crash. Correct.
Thank you.
But I will say that I do think that we've seen things like this before, and I do think that it's very important of what Adenike was saying, which is I do think the floor has been raised in Africa, where these valuations that we've seen in the past that were undervalued, objectively undervalued by any type of valuation methodology you're applying in comparison to peers in Southeast Asia, in comparison to peers in Europe. I think that world is gone, especially in Nigeria. I think now the question is, are we maybe perhaps undervaluing the limitations of the market as it exists in the midterm? And what I mean by that is, are there elephants in the room around GDP growth? Are there elements in the room when it comes to currency risk and things? Are we actually pricing in the risk still, or is it throw caution to the wind time, and are we kind of simply just trying to get allocation at this point?
No, thanks for that. Very interesting perspective. Raj, you had something to say?
Yeah, so I think first of all, Annika, again, very great summary of where things are. I think the one observation I have in response to you is that I'm not sure a lot of founders understand the meaning of having too high a valuation at an early stage, right? Because there's so much kind of fan flames and all the rest of it, and everyone's just super excited. And you just close around and then you kind of figure out afterwards that actually the metrics don't work for you to get to your next round without doing a down round. I think that piece of education, understanding how these things work, hasn't really filtered through right to everybody. So you're just being fueled by this excitement about the market and the excitement of the pay stack and Flutter Wave and this whole sort of space, right? So I think it's going to take a while for people to calibrate what that means for them by having too high valuation. We've all seen, I've seen, people getting exuberant valuation and then you having to do a down round, and that can really, really be much more damaging than having a realistic valuation. So that's the first point. I think the second point, and responding to Stephen's point, and I think there is definitely a massive FOMO going on, right? and I suspect that I'm sort of one of the people that always think, should I really be doing this? Because everybody else is doing it. And some of the underlying things like GDP growth, currency risk, political stability, perhaps is caution being thrown to the wind. Look, at the end of the day, you've got to sort of analyze each company on its own. But my fear is that right now you have a imbalance between that founder and investors, where the founders are being fueled by, perhaps, I don't want to call it dumb money, but certainly money that perhaps not used to this market. There's a lot of people throwing money into this stuff which perhaps don't understand how these things work and are prepared to accept the valuation just because they're the hottest kid in town.
Thanks for that, Raj.
Can I quickly add to that?
Yes, please.
Those are great points. I would also say that there's responsibility on the investor side, right? Where when it comes to market cycles that are super hot like this, there's somewhat of an implication that there will be deals where you will not hold the bag at the end, right? So we can get a company valuation up to the moon or wherever you want to get it to, but if you're not holding the bag at the end, you're able to sell in secondary at the the super hot round that happens to be in the growth rounds, you're fine. But this is a dangerous game to be played, as we've seen in some of the large Silicon Valley companies that have gone through that cycle. But I think, we can talk about founders not truly understanding valuation and the dangers of down rounds, which I think a lot of it just has to be experienced from other founders, convincing folks that it's very painful, and it is a very painful experience. But the other thing is, at what point do we recognize as a community of investors that holding the bag is not necessarily a sustainable strategy through all these cycles?
Thanks for that, Stephen. I'm curious, Laurent, your opinion on this, because you're investing in a number of different continents. What have you seen in terms of valuation, overvaluation, and evaluation?
Well, that's it. I tend to agree with Raj in saying that you have to evaluate it, basically on a personalized level, company per company. But taking it as a whole, I'm seeing two things. I'm seeing that there is some discrepancy between the different sectors. So you have a sector that's out. For example, the fintech sector is clearly outpacing some other sectors within the startup space. And the other, I see, because I see it from like you are, Jim, I see it from the point of view of the investors, from the United States. I see that, there is a lot of room to grow, and that there is a whole lot of room for US investors to get interested, on the mainstream level to African startups, which is going to create, exactly. So I'm seeing, it's starting to happen because, I have many friends of mine that are, huge investors and that I speak to about Africa. There is still a little bit, gingery about taking the leap, taking the jump. So but I think that, this type of educational pieces, this type of talks and discussions and sessions about, basically the benefits of investing in startups in Africa needs to be continue, because I see that there is a whole lot of still, Africa has been the victim of, bad press. And when I say Africa, I mean, most of the countries on the continent have been the victims of that. And I think it's going to take a little bit more to build trust at the mainstream level, and that's gonna once that happens, you're gonna see valuations skyrocket. This is a company that has, that there is real need for some of the startups solutions that are being provided and that are not being met right now in the market.
Yeah, so I think you're absolutely right. Once some of the international investors get more exposure and understand the markets better, hopefully we see more investment coming in. In fact, some of those friends of yours who are interested and on the fence, send them to Cape Town, send them our way. As you know, we're organizing a investor mission or investment mission to Cape Town this May and also in October, really to introduce international investors to the African market. So send them our way.
I definitely will. I'm coming myself. So
absolutely, you definitely should. Absolutely, lots of good food and lots of good wine. Oh yeah, we were talking about investment. Sorry, not about food and wine. But we also see that when African companies are incorporated overseas, whether it's in the US, the UK, or even in the Netherlands, valuations tend to jump quite a bit as well. Have you seen that? Any of the panelists? And how would you explain that?
I think that it's a function of the fact that by doing so, they're exposed to a larger pool of investors who are willing to invest at a higher price.
So it's just a supply and demand thing.
Exactly.
Primarily. Okay. And Raj, I know that in many of the deals that you do, you're pretty insistent, as I usually am, on having them incorporated in the jurisdiction that I feel comfortable in, or that you feel comfortable in. What are those jurisdictions, and would you invest in a company that is not incorporated in the UK or the US or in Europe?
Yeah, so I've done, just to give you context, I've done US, UK, I recently something in Holland, I've looked at something in Singapore, and these are and Mauritius. Okay, those are 5 countries I've invested in, and I'm very comfortable with all those 5 countries. Israel is something that I looked at and almost invested in something, and I think Israel, I would add that as probably also a country that I would be comfortable with, but I don't know it as well. I think anything other than those handful, I would have serious reservations. I certainly would never invest directly into the relevant country. So I would never invest into a Nigerian startup that's incorporated in Nigeria or in Kenya, etc. For lots of reasons that I don't think it's anything to do with bias or anything. It's just about some very simple reasons. How do you get your money out? Governance, laws, lots of good reasons, which if we can go to if people are interested. But to answer your question, no, I would not, right? So I would only invest in a holdco structure which is in jurisdictions which I understand and I'm familiar with. And there are also often there are tax considerations as well, right? So, I mean, Jim, you and I have talked lots of times about the fact that as a US investors, there are a lot of tax advantages of investing via Delaware C Corp. As a UK investor, as I am, there are a lot of advantages of investing in a UK company which has EIS and SEIS, which is like a tax scheme where you get rebates from the government for investing in early stage companies. So those are also valid considerations. But I think the overall consideration is that I wouldn't invest directly into the country of incorporation of where the operations are.
What about markets, though, in terms of companies who are incorporated overseas and are not because of that, but have a strategy of targeting US customers or European customers? Doesn't the target market matter?
Yeah, of course. If you're looking at, you mean target market as investors or
in terms of the customers?
Customers. I'm not convinced that matters as much as to where you incorporate. I mean, you could be a UK company, targeting US consumers, you just set up a subsidiary, right? A US subsidiary. I don't think it's, I don't think that's that difficult. But the question is, where is your money going into? At which level is it going into, right? So you always want to be at the top level, at the whole core level. And at the whole core level, you want to be in a jurisdiction that A, you're comfortable and familiar with, and B, has, in some cases, has some tax benefits to you.
Any other thoughts from the panelists? Anike, Stephen, Laurent. Go ahead, Stephen.
So we've done investments into companies incorporated in Nigeria and Kenya. Specifically, we definitely prefer Delaware companies. It's just a jurisdiction that everyone understands. I think, like Raj was saying, from a tax perspective, from a legal perspective, it's just much more. It's one of those risks that you're able to just essentially checkbox out if you know that they're a Delaware C corp. I mean, I would advise all founders to consider it as a way to set a strong foundation. There certainly will be investors that will not put money into you, given some of the risks that are brought up along those lines, for good reason too. But we've done a lot of the legal groundwork to be able to understand our risk exposure, and we're comfortable with it. But just know that it does open up like the basics, or the basis of investment that you're able to reach when you do have a Delaware C corp.
Hey, Stephen, be interested if you could tell us a little bit more about why you made the investment into the Nigerian company, and whether there were any issues, or even the other one. We're really interested, because I'm part of my thesis is that I'm also kind of wary, because I've not had the experience, right? So maybe if I had the experience and it was all wonderful and plain sailing, then maybe I would, right?
It is, I guess, with legal issues, it's never wonderful and plain sailing. So this was something that we did in collaboration with Flourish Ventures, mostly because this is an issue in the ecosystem where a lot of startups are incorporated in their home base, which makes a lot of sense. And they're really, in the long run, you'd like that to be not a barrier, but it is now. I would say that what we found is that there is not that consistency of experience across terms that people are comfortable with, especially when you're working with local counsel, that I've seen a lot of different, sometimes onerous terms from investors. One issue around this is just, can we standardize terms, and can we standardize the requirements during signing? We've run into issues, for example, around digital signatures, which have, maybe one anecdotal piece of evidence is that a lot of the folks that we have signed initial safes, for example, with, or initial kind of shareholding agreements with, they in the end still transfer into a Delaware C corp at some point, and it's much more expensive after things are more legally complicated.
Right.
So I would say one thing that would convince someone to incorporate locally first is sometimes there are kind of licensing where the regulators require that you have a certain amount of your company that isn't held elsewhere. But outside of that, I haven't seen a great case of why you shouldn't at least consider starting as a Delaware C corp.
Yeah. And I think you make a great point, Stephen, about the timing for incorporating overseas, because if you do it too late, it can get very cumbersome and expensive. So, doing it at the right time, I think, matters. All right. Well, I'd like to open it up to the audience as well. I know several people have joined: George Payne, Marc-Henri, and Sean Elliott. Love to hear your comments and your experience on this topic. Who'd like to start? George, you've been around the longest on stage. Would you like to do a quick introduction of yourself and your comment or question?
Hi. Yeah, thanks for having me. So my background is in financial technology. We also started a group called the African Tech Alliance, which brings together investors as well as entrepreneurs and other stakeholders in the African tech space. So one of the things that we've picked up on is just the consistent problem with Forex as well as political risk causing. It would be interesting to know the other sort of panelists' views on how that could be mitigated, and then their own sort of experience with the implications of political risk and forex on companies, whether they're registered and selling into a global market or domestically.
Gotcha.
So
Thank you for that comment.
there's no cure for political risk. Let me tell you quickly.
Indeed. Well, great. Thanks for that, George. Marc-Henri, you've been on for a while. Please introduce yourself and love to hear your comment and question.
Hi, Jim. How are you doing? My name is Marc-Henri Jean. I'm a Haitian native, U.S. citizen. I live in Florida. I'm a licensed investment broker. I'm a real estate agent. I'm a former journalist at Overvalued, the only daily newspaper in Haiti. I'm very happy to see the former Prime Minister, Mr. Laurent Lamothe. My question is, while Haiti is in the American continent, why do we have so many unfortunate advantages comparing to investment opportunities versus the Dominican Republic? Is it because we have more political instability and risk investment like the countries in Africa, or is it because of bad political leadership?
Great questions. Love to hear from Laurent on that. Laurent, I think you're on mute, by the way. I put you on mute. So you might want to unmute yourself if you have a response to that.
First of all, Marc-Henri, thank you very much. It's a pleasure to see a fellow countryman on the clubhouse. So thank you for the question. I think it's an excellent question because this is something that I get asked myself all the time in all the talks that I do. Is I think, look, we have to look at it two ways. Why are people investing more in the Dominican Republic than they are in Haiti? Is it because I don't think it's because the Dominican Republic. I mean, let's look at the sectors, for example. You have the Dominican Republic makes about $4 billion a year in the tourism sector, while Haiti is at less than 50 million right now a year. So that's a huge gap. Then you have the mining sector, okay, where they make another 4 billion and Haiti makes zero today. And then they have some business outsourcing, call centers, etc., where they make about, over 200 million and Haiti makes about, between 10 to 20 million. And then when you look at, for example, the assembly sector, Haiti makes actually more than the Dominican Republic. So the simple answer is this. It's the legal framework in many aspects is more beneficial in the Dominican Republic in some sectors than it is in Haiti. So because they have better tax benefits, because they help the companies a little bit more, the credit is easier to get in the Dominican Republic than it is in Haiti. And then we cannot deny that the political stability is a huge factor. In the Dominican Republic, they've had, they enjoyed lots of stability, whereas Haiti has enjoyed a lot of instability. Okay, if you look at it in the past, 30 or so years, we've had 25 different governments where they had maybe 4 or 5. Okay, so that contributes to the political risk that George was talking about. That increases and that decreases. Once the political risk increases, it decreases the investors' appetite to invest in your country. So we see that as a huge factor. Now, I think that once Haiti can regain some footing in terms of stability, and we've seen it happening in flashes, but we see it happen. Haiti has certainly one of the most beautiful landscapes, in the Caribbean. The most beautiful beaches, the most beautiful weather, the cuisine. Yeah. I mean, we have everything to succeed, but what it's gonna take is the political will, and everybody is putting their minds together. Haiti has huge brain drain. Marco, I don't know where you are, but we have a lot of brilliant Haitians that are abroad, that are contributing abroad. So we're gonna need to get that, to get that back into Haiti, and to succeed. Look, I think it's a mindset also. I mean, we need to, as Haitians, we need to believe more in our country, and definitely help out in terms of the stability of the country, generally, and then we'll see the investment follow.
I mean, I certainly would love to see more stable political environment in Haiti. That would make certainly my life a lot easier.
Sure.
But yeah, that's something that we definitely want to work towards. Thanks for that, Laurent. Yes, please, Marc-Henri, go ahead.
Yes, I would like to take this moment to extend an invitation to you, Mr. Lamotte, and obviously all the other speakers, because I have a room, the Yes to Love room, and what I've been trying to do is to take people with great professional background and also success stories to expose them to Haiti. I'm 33 years old, and Mr. Lamotte might know that very well as well. I noticed I've never been exposed to success story until I left Haiti to go to France and move to the United States. I think that has a lot to do to the mindset where I'm like, hey, it's possible for someone to be successful, because my parents taught me that when you are successful, you have to do two things. Either you are corrupted in the government or you're stealing money by doing business with unethical practice. And I believe this is wrong because I've been exposed to that. Will you guys be willing to accept an invitation so that we can expose the Haitian people, either in the diaspora or in Haiti, to a different mindset, because it's definitely important. That would be an invitation for everyone here, whether the speakers and moderators.
Right, especially Laurent Lamotte. Of course. With pleasure.
Avec plaisir. Avec plaisir.
Avec plaisir.
Absolutely.
Thank you so much.
Well, thank you for being on, Henri, and thanks for that invitation. I'd like to hear from Sean Elliott. Sean, please introduce yourself.
Hi there, Jim. Thanks for the opportunity. Yeah, I'm Sean Elliott from South Africa and based in Europe. Very enthusiastic about Africa's growing tech scene, especially on the fourth industrial revolution space. And basically my question is, in a way, of how do you guys as investors, what information do you gather to evaluate the startups that you're going to invest in a way of, is there a baseline, a document that you use from maybe one of the big four, Deloitte, EY, or any of the other branches of the consultants to evaluate what is valuable in the tech scene in Africa? And kind of that's my question.
Thanks, Sean. Anybody?
Gosh, I wish there was something. I think there are some, sort of basic, I think what you're asking is kind of almost like a due diligence kind of checklist, but I don't mean due diligence in the sense of a legal due diligence or a private equity due diligence. I think you're looking at a checklist of what are the things that you need to look at when you're investing in a company. And I think there's some basic stuff, like we talk about, ease of where getting money in, money out, and all the rest of it. But there are obviously some other things, metrics and financials and team and all the rest of it. I haven't seen, I have seen something that sort of gives you, I think I have somewhere a list of those things, but I'll be interested to see whether there is and maybe Adenike, whether what you use as a checklist when you're looking at companies. I have a long list and a short list.
Yes. Okay, awesome. So because we invest again at the very earliest stages, there's not a lot to work with, especially if you want to be founder friendly. But we do make founders go through certain exercises. So what does your pitch deck look like? What's the story that you're telling? And then we work together with you on a financial model just to see like what are the unit economics for this business and what do the next 2, 3, 5 years look like in terms of growth? What milestones do you need to hit? Our finance partner at the fund actually built Flutterwave's model, and it ended up being accurate to a T, and that really helped their Series A raise. So that's an exercise that we work with founders to do because it just sets them up for a lot of success. Another thing that we check for is the founder's background, reference checks. Where have they worked? talk to previous employers, obviously in a very discreet manner, or people who have worked with them or have links to them. Aside that, honestly, we just write the checks and work with them to make it the best company that we can. But we're not going to make them jump through many hoops and, fill documents and fill 1,000 legal documents just because we understand that at the very earliest stage, this is not worth it for a lot of founders, and it's not the most founder-friendly experience.
Thanks for that, Anunike. I'm going to also read a couple of questions and comments from the audience online on LinkedIn and YouTube as well. We have from Janasa on WhatsApp, what should happen first, incorporating in Delaware, then local country, or is the reverse okay, provide too much time hasn't passed? Any comments on that? Anyone?
I don't think it's fatal to have incorporated locally. I've seen it before. So the one I did in Egypt, actually they incorporated locally in Egypt, and then they created a whole co in Holland, just because Holland and Egypt have got some treaties which makes things easier. So it's not fatal, but I would always say, it's easier to do it the other way around, to actually either do both at the same time, or to do, basically get your structure sorted out quickly and do it at the same time, right? You obviously need an operating company at the country level to operate. So, initially, especially when you're not taking money, it doesn't matter. So you can have that operating company initially, but then as soon as you start looking for investors to come into the company, then you should be looking at your whole core structure. And so I would say do that. You can stagger that, but ideally you should do it at the same time.
Gotcha. Thank you for that, Raj. Second comment or a question from Aisha on YouTube. Some African countries are now very aggressive on transformation with focus on ease of business, especially Kenya, Rwanda, Uganda. How much of this would move a needle for investors? Comments?
This is Isaac, and I'll quickly just comment on that question, because that's an interesting one that even I learned some more about recently. And I'll speak from a Nigerian perspective, even though the question didn't mention Nigeria. The recent revision to our CAMA law, like Companies and Allied Matters Act law in Nigeria, makes it actually relatively very easy for angel groups, right, to form and syndicate pooled investments to fund startup investments. And so we would increasingly see more people go that route and participate in early stage investing in Nigeria. And most people would say, what about the accredited investor rulings in the US? Africa does have similar rulings, especially in Nigeria, but the threshold or barrier to entry, if you will, is a lot lower in Nigeria. So most people, young professionals in Nigeria, would actually qualify easily to be able to partake and be angel investors.
Well, thanks for that, Isaac. Please introduce yourself as well, and do you have a comment or a question?
Name is Isaac. I am a finance professional. I am based in the US. I'm from Nigeria originally, and I am an angel investor in the Nigerian tech ecosystem.
Great. Glad you could be on. We also have Ayoboni as well. Ayoboni, would you like to comment after your introduction?
Hi, Jenny. Thanks. I hope you can hear me.
Yes, we can hear you.
Yeah, so my name is Ayobuni, like you said. I work as an investment professional in Lagos. I've been working in Lagos for about 10 years. Started off really focused on energy and have sort of started looking at other sectors. And I think, technology has become a focus sector because the opportunity has just been impossible to ignore, so to speak. And I joined because I had a few comments and questions just exploring some things that I didn't think were touched on in actually the question about if African startups are overvalued or undervalued, and then some questions about data and jurisdiction. So just starting off with the thoughts that I don't think were explored. I think a lot of, essentially valuation decisions are driven by investors. And I think depending on the type of investor, valuation sort of perspectives could differ. So just typically thinking about valuation, whether an investor is a financial investor or a strategic investor, I think the general theory is that strategic investors tend to pay more for opportunities with financial investors. So thinking about African markets, where they're relatively nascent or underdeveloped, and there isn't really a lot happening in sort of the strategic space, specifically as far as startups are concerned, or there's not a lot of sort of corporate venture capital. My hunch would be that as that increases, as the markets mature, then valuations, especially in sectors where there's corporate venture capital happening or where there's strategic investors, increasingly valuations would increase. So that's one thought. I don't know if there are any thoughts around the types of investors that are driving allocations into markets and what the impact on valuations of those various investor types is. And then my questions more specifically are around data and jurisdiction. So in terms of data, I'm just curious about if there are sort of public data sources that people tend to refer to that, because I haven't seen a lot in terms of data on technology in Africa in terms of valuation multiples. I see like averages, and I think there's some history around how increasingly technology EBITDA multiples are the highest relative to other sectors on the continent, where historically like consumer staples were the highest valuation multiples. I'm curious if people have data sources that they're referring to and can share on here. And then
thank you for that. Yeah, so go ahead.
Should I go to the next, or do you want to comment now?
Sure, let's hear if there's a response to your question about data sources for African startups and valuations. Anybody? Stephen, perhaps?
I would say like in a lot of venture everywhere, a lot of this is kind of conversations, right? So systematically, I don't think we've utilized a tool or a database specifically to track valuations. I think we track it internally. We are starting to look more at different external sources, not necessarily just for valuation, but also just to get a sense of how ecosystems in specific industries are forming and how they're interconnecting. There's great work being done by a bunch of folks out there. Brighter Bridges is one of them. Shout out to Dario and team there. There's certainly now more stuff on Crunchbase as well. So I think a lot of this is kind of cobbled together, if to be very realistic, in our own internal spreadsheets and databases. And the things that we do use, we kind of use it to fill out gaps or supplant. But in reality, I think this market is still relatively closed and small, maybe not closed, but small at least, where you can make calls and you can have conversations and you can get a general gist of what is going on. I don't think we'd be doing our jobs if we didn't continue to do that. So that's just, I think it's part and parcel and part of the business. But we are seeing, like I said, more third-party services and more third-party data gatherers and aggregators that I think are really interesting.
Gotcha. Thanks for that, Stephen. And yes, just another plug for Brighter Bridges. They have quite a bit of data on the African startup ecosystem. So definitely a place to look. Brighter, BRITER. All right. And do you have a second comment or question?
Yes, I do have a second question.
Go ahead.
So the second question is, on the point of jurisdictions, I'm curious if anybody is seeing a preference by, I don't know, for instance, impact investors, or I guess more socially conscious investors, or investors that are interested in reducing inequalities and those sorts of themes. A push for those investors to back startups that are registered locally, just because of the idea that potentially there might be those startups may be less extractive in or do more to contribute to the local economy. Curious if anybody's seeing that, or any thoughts on this.
Any comments on Anike, perhaps? Anybody?
Yeah, I could jump in, and that's a very interesting one. And I would say, like, in my own very short investing journey, I have been deliberate and thoughtful about investing directly in my case, like Nigerian and sub-Saharan African founded and companies that are operating in the region, and are actually making impact to the region across the UN SDG teams. But I've not taken it to the level of saying well, the holdco must also be registered there. For me, it's primarily the operation, because if you think of the holdco, I think someone mentioned earlier, for various reasons, whether it's to attract venture capitalists across the globe, or to even get higher valuation multiples, most companies prefer to have some sort of holdco in either Delaware or somewhere in Europe, or even in the Cayman, depending on what VCs they're trying to attract some sort of capital from. And I wouldn't fault people for that, right? Ultimately, if you're operating in the region and you're making impact to the lives of people in the region, and your cap table has a decent number of exposure to investors from that region, I would back those kind of people.
Thanks for that, Isaac. Rain, thank you, Ayaboni, for the questions and comments. We also have InsurTech Africa, who has joined on the stage. Do you have a name other than InsurTech Africa? And please introduce yourself, and we'd love to hear your comment or question.
All right. Good evening, everyone. Thanks very much, Jim. My name is Tunde. Fantastic work you guys are doing. So I run a platform which is building the insurance technology ecosystem in Africa for the purpose of fostering penetration and inclusion. My question actually goes to you, Jim. I did hear when you mentioned earlier that you're planning a trip in May and in October, respectively. Is the trip focused based on investors, or is it also inclusive of founders? Is there going to be an opportunity where there's going to be maybe closed door, open door meetings, where it's going to be like a peer-to-peer matching or something? What's the focal point of this plans? I'd like to learn more about it. Thank you very much.
Great question. So the focal point of the South Africa Showcase, as we call it, is to bring international investors, with a major focus on American investors, to the African market, and in particular focus on companies that are going global, as I would call it, or simply focusing their customers, focusing on customers in the US and in Europe. And in particular, companies that are incorporating as US C Corps, such that American investors can invest in those companies and realize some tax advantages for investing in US C Corps. So will there be an opportunity for founders and entrepreneurs to speak with investors? There'll be somewhat limited opportunity for that, but we certainly do welcome entrepreneurs and others who are open-minded to investing in South African companies and other African markets to join us in May or in October. And you can find out more if you like by contacting me or simply connecting with Untapped Global.
Thank you very much, Jim.
Welcome. Thank you, Chinde. Okay, we also have Darren on the call as well. Darren, would you like to introduce yourself and ask your comment or ask your question or provide a comment.
Sure. Hi, everybody, and hi, Jim. So my name is Darren. I'm from South Africa, and I've got quite a big interest and passion for the startup ecosystem in Africa and South Africa as well. So just basically just a comment based on the topic in terms of are African startups over or undervalued. There is some research out by an organization called GALI, G-A-L-I, which collects data from accelerators all across the world. And they've collected information from accelerators. And what it shows is that sub-Saharan African founders or startups, they receive much less equity investment compared to other countries and other regions, even though the amount of revenue that they've generated is more than the other regions. So the information it says here, 9% of startups in sub-Saharan Africa reported that they had raised some outside equity. And in terms of the percentage of companies that have prior year revenues, that was 58%. Whereas if you compare that to all the other different regions, much lower percentages of companies that had previously had revenues, and also much higher percentages of equity that they received. So based on that research, I would say that startups in sub-Saharan Africa compared to the rest of the world is actually not overvalued. However, I will also say that within the various different sub-regions in sub-Saharan Africa, like Kenya or Nigeria or South Africa, potentially some of those sub-regions might be maybe a little bit overvalued in comparison to the rest of sub-Saharan Africa. So yeah, that's just based on my comment. That's just based on the topic. Hopefully that adds value to the conversation.
Thank you very much.
Darren?
It absolutely does.
Sure. Yes.
Sorry, Jim, if I could ask Darren a question. Darren,
please.
You and I have sort of talked before.
Yep.
I'm grateful to receive your weekly, or I can't remember, was it weekly or quarterly weekly updates, and they're really great. And if anyone doesn't receive them, please do. And I don't know where, Darren, you can tell us how you can get those. They're great updates as to what's happening in the Africa ecosystem. I find them really, really useful. But are you now, I mean, I think what you're doing is collecting data, right? So is there like, how are you planning to monetize this? What are you doing with this data? Because I think a lot of the data that you are collecting is like really, really interesting from just from a sort of looking at the landscape and how it's changing. What are you doing with the data, and how can people engage with that data?
Yeah, that's a very good question. Thanks for that, Raj. So at the moment, there's a plan to try and automate some of that data collection process, to try and work with a number of investors, so that the data collection process is less manual, and the plan is also to keep that open source essentially, so that various different people that use and would want to analyze data for research purposes can access that free of charge, and then do their research. Because as far as data collection goes, it's quite resource intensive in terms of just collecting that from various different people, various different investors, and also just scraping the internet. So yeah, I think the idea from my side and working with a few other players in the industry is to try and automate as much as possible, so that it removes that cost. Because I think the lack of information about the system, the ecosystem in Africa, does create some sort of information asymmetries, which, as you can see by the information that I just shared, results in perceptions of risk being higher. So that results in less capital actually flowing into the ecosystem. So the idea is just to build a more robust profile in terms of sharing that information. So yeah, so if anybody is interested, they are welcome to connect with me on Twitter or on LinkedIn. I share a weekly update, just sharing information about the various deals that's taken place in the ecosystem.
And your Twitter handle
I'm going
is...
to give a plug for Darren. I think it's a really great little thing. I really look forward to reading what's happening every week. So no, please do follow it. And Darren, good luck with that.
Thanks so much.
And how do we follow you, Darren? Are you at Darren DarynMunnik?
Yes, that's correct. So on Twitter, it's my surname and then my name. So that's MUNNIK, Darren, DARYN. That's my handle. And then on LinkedIn, it's just my name and my surname, DARYN, Munich, MUNNIK.
Perfect. Thank you, Darren, for that. And Thanks. Now let's move over to Bemi. Thank you, Bemi, for joining us.
Thank you for having me. Just a quick comment from me. So we're having this conversation about, first of all, about myself. So I run a company called Talking Drum Communications. Just a full disclosure, because I think my comment kind of links to what I do, but I promise this isn't a plug of my services in any way. But we're having this conversation about valuation of African startups. And I think we also have to have another conversation alongside that if we are going to go or get to a place where the valuations are more accurate, especially in a time where the pot of money that is funding a lot of the work is going on in Africa is coming from outside Africa. We then need to have a conversation about how the stories of innovation and how the stories of entrepreneurship that are happening what is happening in Africa in terms of innovation and entrepreneurship. How do we get those stories in front of the people with the deep pockets that we need to fund the growth that Africa needs to see? Because if you look at most of the international publications that you have, a lot of them, when you see the Africa correspondent and you click down the list of stories that they write about, a lot of them, quite often, it's about wars and corruption and farming and all these sorts of old, like cliched stories where you have to look very hard and very intensely. Well, yes, there are a few publications, the CNNs, the BBCs, and increasingly CNBC and those kind of guys that are writing more stories about what's going on in Africa. But I think we also need to have a conversation, because the way the continent is portrayed externally doesn't always reflect the nuance of what's going on. Most of us in this conversation here are very aware of what's going on the continent, and I'll take a wild guess that we either stumbled on it or someone brought that information to us. But I think as we get into this next phase of the African development story, as we get to this wonderful phase where innovation is spilling out of the continent at every from every angle, I think we owe it to ourselves, especially as Africans and anyone with an interest in Africa, to make sure that these stories travel well and travel to the right place they need to be, so that the people with the interest and people with the pockets can see that innovation is happening in Africa. And also in terms of the risk as well, once people are aware of the nuances and the context and innovation and the wide varieties of stories and realities that are existing in Africa, then people will be able to make more informed decisions in terms of how to invest, where to invest, what to do, and basically just have a clearer idea of what's going on. So I think we need to have that conversation alongside as well. How and when or who, whatever, all the details of that, yeah, we may need to work that out over time. But I think until that happens and these stories are as part of the African narrative as all the other stuff that we are used to seeing, I think, yeah, we may have to travel a little way longer before we see like a fair valuation of African companies.
Thanks for that, Bemi. So, we see as one of our goals, meaning Untapped Global, one of our goals being connecting international investors to the African continent. And one of the ways we do that is simply exposure, having entrepreneurs pitch directly to them so they have substantive conversations via Zoom, virtually, so that they can see this, the preconceptions that they might have about the continent may not be accurate. We also try to get international investors to the continent in ways that are easy for even the most closed-minded to easily accept. So, as I mentioned previously in this hour, we are hosting a session in South Africa in May and also in October to invite international investors to come join in South Africa and meet the venture capitalists and the startups in the country. So they get simply exposure to a new market. So I'm hoping that maybe please stay in touch and get in touch, in fact, and maybe there are some ways that we can collaborate to spread the word more broadly.
So I'll definitely be in touch. Thanks, Jim.
All right, thanks, Benny. Thanks for joining us. Over to Ben. Thanks for joining us, Ben.
Hi, everyone. Thanks so much for talking, and great to sort of talk to some of you at least again. I'm Ben. Obviously, I'm an analyst at Global Ventures. It's a Dubai-based venture capital fund focusing on emerging markets, and I'm the analyst on the Sub-Saharan Africa investment team. And my question revolves sort of like going back to some of what we were talking about earlier about valuations increasing or decreasing for African startups. And we talked a little bit about how they might be affected in the terms of like fintech sector with Flutterwave and Paystack having proven the models that they're able to scale to unicorn status. And my question is more so in terms of how those valuation exercises might change or differ on a more sector specific level, and how or if we should change some of our valuation exercises or methodology if we're evaluating companies like in the health tech sector, agri-tech sector, education sector, how they differ between sectors, and whether or not some of the success of certain fintech companies has trickled over or can be applied to rather some of the other sectors on the continent.
Thanks for that, Ben. Any of the panelists interested in answering that topic or question?
Sure, I'll take a stab at it. Thanks for the question, Ben. It's a good one. We're, as a firm, DFS Lab, we're really passionate about stuff outside of fintech now, although I say previously we were very focused on fintech. And I would say one way to think about this is that as you think about different pieces of what your product or your startup needs to scale, what are the pieces of infrastructure that have to exist, right? So in the fintech sector, I think what we see is there's a lot of digital rails that have to happen, and people are building those digital rails. I think one argument we're making is that is inherently a limited set of potential consumers. Even if you're doing B2B, at some point your B2B consumers need to go from B2B to C. And so we see that as there's a inherent limitation right now in the market there. But on the infrastructure side within that group, if you're able to build pure digital rails, you have a great argument for very cheap distribution. Now, when you look at other industries that have much more physical touch points, whether it will be agriculture, as we're talking about, healthcare, one that I admittedly don't know much about, but at least on the ag side, we've invested in a ton of ag companies, and from day 3, they're going to hit limitations around their supply chain, right? How do you go from farm to table, farm to retailer, farm to supermarket? And those pieces of infrastructure are not digital, and so you cannot build them as quickly using an AWS server, right? This requires things like micro warehousing, which requires a pretty intimate knowledge of supply chain. And so one way that we've looked at whether a valuation is reasonable is how much does it actually take for a company to meet those kinds of distribution bottlenecks and relieve them, whether it's them doing it internally, which has a certain amount of R&D, et cetera, time cost, or whether it's partnering with a third party that's doing it well. And I think we'll see valuations rise as distribution is eased for everyone. There's kind of a tragedy of the commons issue here, right? So once we do see better, for example, freight, as we're seeing a lot of great freight startups happen around East and West Africa, those benefits kind of trickle down to all. And so maybe one way to think about it is, how is distribution inhibited or not based on the models that you're trying to fund?
Thanks for that, Stephen. Thanks for the question, Ben. And thanks for being on. We also have Anthony. Welcome back, Anthony.
Hi, guys. Sorry, I was typing away and got sort of distracted. Could you remind me on the question? I'm guessing it's
Just introduce yourself and what your comment and question might be on this topic.
Sure. Yeah, so I'm based in London, and in effect we're an investment office, and we deploy into renewable energy projects globally, as well as venture capital globally. And just to sorry, you said I haven't got a question. Sorry, I just was invited up.
Gotcha. No. Thanks for joining us. I thought you had a comment or a question, but great to have you back again. Well, with that, I think we've passed the hour, end of the hour, and so I want to thank everybody for joining us today. And we'd love to hear from you. So please connect with us via our WhatsApp community, and you can connect with the WhatsApp community by going to untappedglobal.com and clicking engage and join our WhatsApp community. And we'd love to hear from you on future topics for this Clubhouse chat. And with that, we want famous or not famous, but last words from the panelists. So Raj, Adenike, Stephen, how do we improve valuations for African startups?
So I think the how do you improve is more good news, right? I mean, the better the news is, the better the valuations are. If you're looking at it purely from a it depends on what you mean by how do you improve it, right? As an investor, I'm sort of saying, hey, don't improve it too much. But as a founder, for the ecosystem, I think it'd be good to have better valuations, because I think everyone wins then. And I think the answer to your question is, the more good news stories there are, that's naturally going to be an increase in valuation.
Thanks for that, Raj. Thanks for being on.
Yes. That sounds great. I mean, for me, it's just be realistic about what the future of your company could be like, but give yourself a lot of room to grow. Better to be undervalued at the earlier stages than overvalued and have to do a down round. Also communicate really clearly the basis and justification for your valuation, because in those cases, it makes it really difficult to argue with. But overall, I think that we're in a good place for valuations right now. And as more successes happen, that will still, we'll see more of that. But we also need to be realistic. We're in day one of this journey.
Thanks, Adenike, and thank you for coming back again on the Nest. Stephen, final last words.
Yeah, I guess I'll end it with some optimism, which is, this is a great time for founders right now on the continent. As valuations rise, as interest rise, I think you'll have an easier time raising. You'll have an easier time getting your ideas off the ground. And maybe a final point of warning after the optimism, like I always do, just no incentives. Just know when you're getting into these discussions around valuation and deals, know where everyone's incentives lie. But it's a great time right now for the startup ecosystem.
Thank you very much for that note of optimism. And thank you everybody else for joining the audience today. And we will hopefully see you next week. Thanks, everybody.
Thanks, Jim. Always a pleasure.
Thanks, guys.